Hello and welcome to 5-Year Club video number 83. Morning video? What? Yeah, I've known for a while that I need to get back on a morning schedule because I'm going to produce better content if I do that, and it's also just easier on me if I'm not sitting in a computer trying to be social at like 9:30 at night or 10 p.m. at night. What I have done today is I repeated the analysis that I did based on the Redfin data from 1996 onward for a nice area of Chicago. So I just Googled like good zip code Chicago and I got 60602, which is a bunch of high-rise buildings with HOA fees that range between like $400 and $1,100 a month. So yeah, nice amenities in those buildings. I'm not familiar with Chicago, but this seems like it's a business district, and you can pay several million for a large condo here. 2.2 million. So yeah, nice area of Chicago that we're looking at today. And I just wanted to compare it against Lilburn, Georgia, and against the data that I got from San Jose, so we can start to get a feel for how the 10-year equity outcomes change, how they're related to those trend lines, and yeah, just get more familiar with this data, more used to seeing this data. Again, what I did is I took those prices from 1996, I adjusted them for inflation. I think I also multiplied the Chicago numbers by 2,500 square feet just because that's what was already in the spreadsheet. And here we have the price chart for Chicago. So we can see that Chicago before 2008 increased more than, say, Lilburn, Georgia, and when it fell, it didn't fall beyond its previous point down here, which Lilburn, Georgia did fall beyond that. It also recovered faster, and even though it hasn't reached its peak in terms of real dollar terms, we still get an overall upward trend across those years, 1996 to present. Here's all of the equity data since 1996, so we can see that some people get some green, meaning that they had significant equity gains. We didn't see any green at all. In other words, they have as much equity in terms of real dollars in the property as they paid for the property originally. That's what the green means. So we didn't see any green at all in the Lilburn data. We saw a good amount of green in the San Jose data, and of course the San Jose data also covered more years, covered about 10 more years, so that's not surprising. Just like Lilburn and San Jose, we've got a substantial blob of red there, which means that people have less equity in the property than their down payment in terms of 1996 dollars. So in some ways, I guess it's kind of like in between San Jose and Lilburn, but I think it's different in an important way that I'm going to show you, although I think that could be an artifact of the data. All right, this is all of the equity data, so I just plotted this spreadsheet, and we see like, oh, that's kind of nice upward trend there compared to some of the other stuff that's kind of more missile-shaped. And if we just look at the 10-year data, yeah, we get a little bit of green there, not a whole lot. I feel like a weather reporter now. Still a big, blob of red in response to that 2008 housing crash. So yeah, housing crash definitely impacted Chicago too. And then here is a graph of that 10-year data, very similar to the stuff that we've seen before. Now, if you bought above the trend line, if you bought above this price trend line, which admittedly is only based on 22 years of data or whatever since 1996, so it's not a great trend line, then you got a similar graph, I think, in a lot of ways than what we have seen before, except that in San Jose's case, some of the people were still below water here, and so we get some people who are below water, but fewer than San Jose and fewer than Lilburn. If you bought below this price trend line in Chicago, so let's look at the trend line again, yeah, so if you bought below the trend line, which would be here or right there, then your 10-year data looks especially good. Nobody is underwater. You might have less than your down payment for a little while, but nobody is below water if you bought during those years. And that's great, but I also think this is probably an artifact of The fact that data is only from 1996, I would love to get some data for Chicago from 80s, 70s, 60s forward, see how all of this stuff changes. And so now what I want to do is I just want to quickly look at the different graphs of the different places and compare them to each other. So this is if you bought above the trend line, so you bought relatively expensive, you bought in a relatively expensive market. We're going to look at first San Jose, then Lilburn, then Chicago. So this is San Jose. Some people are still below water after 10 years. This is Lilburn. Some people are still below water after 10 years. And this is that area of Chicago. Nobody is below water after 10 years. So Chicago is looking better. And then now this is the above the trend line data. Or sorry, this is below the trend line data. We just looked at above the trend line data. I keep mixing those up. So these are people who bought during relatively affordable markets according to that trend line. The San Jose data, some people were below water for, a period of time, but after 5 years they were above, and everybody in the end came out well. Lilburn data, more people were below water, but eventually everybody came out well. And finally, the Chicago data, nobody was below water and everybody came out well. So, okay, cool. I would love to get more data on this. I think it's comparing the Lilburn data and the Chicago data is probably the most apples to apples because they're both based on behavior since 1996. So it is clear from this data, I think, that people who owned in this expensive area of Chicago had better options than people owning in more middle-class suburban Lilburn. And I think that's something that we saw throughout the recession, the recovery, is that areas that already had a lot of money in them, that were already wealthy, their prices decreased less because you had fewer distressed home buyers in those areas because the people there were economically better off. And I think that when the foreign investors came in and they decided, okay, I need to escape China or wherever it was with my money, what am I going to invest in the next 20 years that I feel good about? A lot more of them chose to invest in economically active places like Chicago, like San Jose, like New York, like San Francisco, rather than investing those foreign dollars in suburban Lilburn, Georgia. So it's not surprising, I guess, from that point of view, that when they made their all-cash offers and those offers snatched up those properties and dried up the supply, which drove prices up, it's not surprising that money went into the cities and not into Lilburn, Georgia. All right, that's it for 5-Year Club video number 83. Maybe I'll do a couple more cities based on this Zillow data. Maybe I will start trying to automate some of this and just cover an easier topic tomorrow morning. Because I really would love to give a tool where we can just very quickly go through cities with a much larger data set and have more confidence in the trend lines and a better idea on kind of is the market undervalued right now, overvalued right now? How much money would I want to put into the housing market based on where I think the value is, and what are my opportunity costs from investing in the housing market right now versus the stock market? Because I'm sure people have stock market value ratings, especially on the S&P 500, because that data is really old and a lot of people are looking at it. Cool. Have a fabulous day instead of evening because it's the morning time.